Ray, in terms of just bottom lining it, for those in the audience this morning that beyond thinking about buying your book are thinking about whether they should be invested in the market, putting more money in the market, and I'm thinking about equities right now, taking money out of the market, how do you value this market today?
I think that just the way you said it is going to be a fool's journey to say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. Or when you see other markets, gold, you're seeing, watch the market action on every day, and you could see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return, and you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets.
Hey, Ray, one of the things you do write about is China. Some would argue that you have a generous or more sympathetic view to China than perhaps some of the most hawks, if you will, about China. But you think that there's sort of an inevitability to the transfer of wealth of sorts.
Well, okay, two things. China, transfer of wealth. I just know China very well, and I come as a perspective, with a perspective as an investor. I've been going there since 1984. I know leaders, and I know how they're thinking, and I know the moves that they're making in a detailed way. And I'm just trying to share what that perspective is, because I think a lot of people make stereotypical moves. And I think you have to really understand, first thing you have to understand, because it has been a remarkably successful place. Since I started going there in 1984, per capita has increased by 26 times and so on. So to not understand it or to approach it with a great bias is a great disservice. Okay, in terms of the element of, let's say, a transfer of wealth, or let's call it common prosperity. Yes, there's a world, in this world right now, there's a move to common prosperity. I think that that move, what does it mean at a technical level? That's not take your money away. But here, I would say what are called progressives here are much more left than what we would call progressives or whatever the Chinese policies are doing. But yes, worldwide, there has to be common prosperity, or let's call it broad prosperity. And the question is whether that's going to come about by productivity or not. It doesn't mean that you're going to have like a communism that's going to take all of that. There's going to be a lot of productivity in China. And so, again, diversifying the portfolio. You look at the United States elsewhere, you have to diversify.
Hi, this is Kaden from VIA Value Investing Academy. Now, thanks for joining another evening of our VIA Deep Dive series where we talk about anything and everything about investing. So before I start, I just want to make sure that all of you are able to see my slide and hear my voice. Let me just share my slides. Now, if you are able to see my slide right now and if you are able to hear my voice clearly, is it okay? Just type 1 in the chat so that I know everything is fine before I kickstart everything. So let me just come back to here. Yep. Okay, so how's it coming? Can you just type in the chat, just type 1 so that I know everything is fine. Okay, good. Yeah, usually there's some lag response, right? Yep, it's okay. You should be able to see the slide right now, VIA Deep Dive Series. And today is quite interesting because the topic that we're going to talk about is about the world's largest hedge fund, which is called Bridgewater Associates. Yeah, so this is the world largest, not the second largest, but the largest. But before that, let's do a very quick recap of what the founder called Ray Dalio talks about. Yeah, and before that, I just like to give credit to CNBC television. Yeah, because all the credit goes to them. They are the producer of that piece of breaking news. Yeah. So let me just summarize what Ray Dalio has shared, some key points. So the first thing, Ray Dalio said that is a fool's journey to time the market. So in other words, most people thought that investing is trying to predict the share price based on share prices in the past, but nobody has ever been able to do it successfully, including Warren Buffett, because in the early stage of Warren Buffett's so-called investing life, he started off learning about technical analysis, but it didn't work out. Yeah, so when he switched to investing, specifically value investing, right now he became one of the richest men in the world with a net worth of about $120 billion. So remember, if you thought that investing is monitoring share price, trying to time the market, just to let you know that Ray Dalio, right, said is really foolish to do it. So that's number one. Number two is he said that cash is not a good investment. I think all of us should know because of inflation. And if you look at the core inflation of Singapore, I think it's about 5+%, and is at its 15 years high since 2008. In short, things are getting more and more expensive. And if you did not deploy your cash into some form of good investment to beat inflation, it's not a good thing. Yeah. The third point that Ray Dalio said that it's very important for all of us to know how to balance a portfolio. Now, this is a bit advanced, right? Because if you do not know how to invest, you cannot talk about balancing a portfolio. So I think at this point, we are assuming that you already know how to invest. So once you know how to invest, how do you balance a portfolio? Now, it's quite dangerous to put most of your money into like one single stock, Tesla or all this. So you have to be very careful. So he did share that from his perspective, he's not managing millions, he's managing billions of dollars. It's important for all of us to create an all-weathered portfolio. So rain or shine, your portfolio still do well. And another part you sort of deviate a bit, which is the part 2, right? Because the host asked a second question, and he talked about China. And he said that most people, I think he's talking about predominantly maybe Biden administration, that there is some form of personal bias, right, against China. You know, every time when Biden administration open their mouth, it's always about China, right? Yeah, so he did say that we have to understand China. It's like trying to buy a stock. You have to understand what is it all about, versus using our bias, personal bias. And he did mention, right, ever since he visited China in 1984, there is this term called GDP per capita has increased 26 times. Now, what does it mean, right? It seems like, oh, something has exploded, becomes very huge. So let me just explain bit by bit in case you're a non-finance person. So what is GDP, right? GDP stands for gross domestic products. So this term GDP or gross domestic products usually is being used to measure the wealth of a nation. Yep. So as of today, right, the US has the largest GDP. Yeah, not GDP per capita yet, it's largest GDP. And then the second nation or country that has the second largest GDP is actually China. Yeah, that's why, US worry about, China is overtaking US in that sense. So GDP is used to measure the wealth of any company. And if you look at the term, right, for example, a domestic product. So in other words, for example, let's say in Singapore, we have businesses, right, that sell services, that sell goods and so on. So if you take all the dollar value of the services and products that they sell, you sum it all up. Yep. So in other words, the larger this GDP, that means the larger the amount of sales of services and products that's being involved in the nation. But of course, usually the larger the nation, the larger the GDP. Yep, so that's GDP. It measures the wealth. So what is GDP per capita? GDP per capita. Now, GDP per capita is simply taking the GDP, yep, and then divided by its population. Yep, so they end up with a number, the wealth of a nation, like per one person. Per one person. So usually that is also used to measure so-called is that individual in the nation rich or poor. But usually not so accurate. Yeah, not so accurate. Yeah. So in this context, in that video, Ray Dalio said that since 1984, the GDP per capita has increased by 26 times. That's a lot, which is why sometimes you hear China, right? Like Xi Jinping saying that, they make a very great, huge improvement in the poverty level of the Chinese in China, right? By so-called eradicating poverty or lifting the poverty level so that people become less poor and they become more well off. So they measure by the GDP per capita. Yeah, then of course he closed the segment by saying that, there's going to be a lot of productivity in China. Yeah. So I think the question has two parts. One is the first 3 points, and the other one is the 4th point and 5th point. Now later on at the second half of my segment, right, I'm just going to give some details about the first 3 points. At the end of the day, how can we make use of the information that Ray Dalio has just shared? And that includes talking about China. So is China worth investing? Yeah, so this is it. But before that, I think very quick, intro, right? Who is this Ray Dalio? So this Ray Dalio looks like the man on the right, just to let you know that his net worth is 19.1 billion. Billion means 19, and then with 9 zeros at the back. And this is in US dollars. In short, he is one of the richest men in the world. Warren Buffett is about 120. Yep. Then the next point, Ray Dalio is the founder of the world's biggest, not the smallest, not the second biggest, but the world's biggest hedge fund. And the name is called Bridgewater Associates. Manages about $124 billion. So in other words, he's somebody. Yeah, so if he's somebody, I think it's important for us to sort of pay attention to what he say, and then he already said that it's really a fool's journey to time the market. Yeah, I think it must make some sense. Yeah, so in case somebody else asks you to go and time the market and he tells you not to, you have to decide who do you want to believe. Do you want to believe an influencer, TikToker, YouTuber, or do you want to believe someone who is one of the richest men in the world, who manages the world's biggest hedge fund, with a value of 124 billion. I think this is asset under management. So with that, let's go deep dive into this hedge fund called Bridgewater Associates. I'm going to invite Hillary to come up, but before that, let me just do a disclaimer so that as much as can we want to share. I think we better do this correctly. So just to let you know that tonight's YouTube Live is really to illustrate the application of value investing methodology and various valuation methods in the context of real life companies. So in this case, the hedge fund. But remember, as much as we like to share, under no circumstances does any of the information provided in the subsequent case studies represent a recommendation to buy, sell, or hold any stocks. So it's important. So don't anyhow press, right? Remember, we do not know you personally, so we do not take into account the individual characteristic, profile, or risk appetite of any one of you. And just take note, in no event shall VIA or any authors be liable to any viewers, guests, third party for damages of any kind arising out of the use of the information shared this evening. So remember, neither McKinsey Investments, VIA, nor me and Hillary are operator affiliated by any broker, dealer, or licensed financial advisor. Okay, good. Now, so with that, I'm going to hand over the airtime to Hillary, who has done a lot of work. So Hillary, thank you for joining us, and I shall hand over the time to you.
Hi, good evening, everyone. Thank you for joining us in our another deep dive series, and thank you for for introducing me into here, and also welcome to all of you to join us in this session. So tonight we'll be deep dive into Bridgewater Associates portfolio. So why we decided to pick this topic, I will explain later. So right now let's jump into it. So first off, earlier on, Kaden has shared that Bridgewater is one of the largest hedge fund in the world. So now with this figure in 2022, we see that it's actually currently at 126.4 billion of assets under their management. So there are a lot of hedge funds around, but currently Bridgewater is still one of the largest. Okay, so let's look at Bridgewater's performance. So in 2018, before the pandemic, we can see that Bridgewater is one of the biggest because we see that their net gains since inception was generating about 57.8 billions. And now with this latest figure, here mentioned 2022, which is a bit small, we can see that even though Bridgewater has slid down to the second place, but it's still one of the largest, the second largest after Citadel. So we can see that actually Bridgewater has been doing quite well before and after the pandemic. So one might be wonder, what is their secrets or their strategy? So we'll find out more. Okay, so earlier on, Kaden has shared more about Ray Dalio. So let's find out who he really is. He's actually an American investor, hedge fund manager, and also a philanthropist. And he is the founder and former CEO. Yes, now he's a former CEO of Bridgewater. And Bridgewater was founded since 1975. And he's actually the author of these two books, Principles, and also The Changing World Order, where he shares about the economy, how it changes from one of the major power to another, like for example, from Netherlands to Britain, then from Britain to US. And will US to China become a reality? That is something we are interested to know about, which he already shared in this book as well. Okay, so right now let's look at what is the investing philosophy or strategy that makes Bridgewater to become the largest hedge fund in the world. So first off, it is known for analysis of economic cycles because Bridgewater believe in the power of data and also analytics to drive their investment decisions. But being a hedge fund, so there are some things that we are not sure, but they also have some information that we can glean off. So let's look at what are their approaches to investing. So first off, earlier on in the video, Ray Dalio also mentioned a bit about how to manage properly about the portfolio. And one of the ways is to doing an effective risk management via diversification. This is because he mentioned that with effective risk management, it helps to minimize the losses and also helps to generate consistent returns over the long term. So later on, we'll be showing one of the portfolios in how it performed over the years. And also, he said one of the investing approaches that they use is to use a computer algorithm to make a data-driven investment to take advantage of market inefficiencies. So what really is market inefficiencies? It's because, like Warren Buffett's mentor, Benjamin Graham, mentioned that Mr. Market is a very irrational person. So for market inefficiencies, it means that sometimes market can become quite imperfect and also behave in an irrational behavior. Like Warren Buffett always likes to say, be greedy when people are fearful and be fearful when people are greedy. So this is roughly what it means about market efficiencies. And next, Ray Dalio also mentioned in the video that it is impossible to predict the market movement or identify which stocks will outperform. But rather than predict which stock will outperform, he suggested that maybe we can look at market trends or potential opportunities via the economic, like the global macroeconomic trends. So global macroeconomic trends means that which direction of the economy is moving in terms of GDP growth, interest rates, or even global events that will influence how the economy will go about. So this is roughly what Bridgewater Associates approach to investing and some of their strategies. Okay, so now let's look at Bridgewater Associates. So it's an American investment management firm where they offer portfolio management and financial advisories for institutional clients. And they also sometimes publishes global macroeconomic research reports. And currently, as of November 2022, they have about 150 billion assets under management for their institutional clients where they invest in these funds. And also, some of their main investment funds are the Pure Alpha Fund, which is their flagship fund. So for this fund, they are actually using data-driven approach to identify market trends and also opportunities via global macro investing method. And the other one that Ray Dalio mentioned in the video is actually the all-weather fund. So this is actually a risk-balanced fund which will perform well during good times or bad times. So this is one of the funds, this is the fund that we will be looking at for tonight. Okay, so now some people might be wondering, how does hedge fund actually works? Because we heard a lot of what is hedge fund, what is mutual fund. We'll explore more on that. So right now, you can see the chart. On top here, you can see that there are investor 1, 2, and 3. So this investor 1, 2, and 3, they are actually institutional investors where they will give money to the hedge fund manager to let them invest for them. So here, the hedge fund manager is actually Bridgewater. So they gather all the money from the investors and they will invest into a well-designed portfolio, for this case, which is either pure alpha fund, all-weather fund, or another funds within the Bridgewater. And from there, depends on which fund they invest in, then they will achieve a specified returns. So this is overall how does a hedge fund actually works. Okay, so right now here's the million-dollar question. What is the difference between hedge fund, mutual fund, and ETFs? Okay, so for hedge fund, it's actually a private investment fund that is only for accredited investors or institutional investors. That means that it's not open for public. And the main aim of this fund is to generate high returns while minimizing risk for their clients. As it is being managed by fund managers, so they may charge high fees for their services. And whereas for mutual fund, it sounds similar to hedge fund, but there's some slight difference. It's because mutual fund is actually investment products that are offered to public. So that means you and I, we are general publics. We can actually go to a mutual fund company to invest in mutual fund. So here, they are aimed to provide diversification and also long-term growth. And similar to hedge fund, they are also managed by fund managers, so they may also charge a certain high fees for it. And now what is ETF? ETF is actually a short form of exchange-traded fund. So it's actually an investment fund that is traded on stock market, where it is being designed to track a performance of a market index or stock, like for example, S&P 500 ETFs. And it is actually low cost and it's also flexible to trade on the stock market. So that means you can buy the stock market at any time, when the market opens at your own pleasure. Okay, so right now let's look at deep dive into the all-weather fund. So this is the portfolio that can work well in good times and bad times because it is aimed to generate a consistent returns across different market conditions. Like for example, whether it's a bull market or bear market, this is able to generate a consistent returns. And the risk balance fund is actually invested in 3 classes. So the first one is stocks, which is like for example, Tesla, Amazon, those individual companies. And also it's invested in fixed incomes or US government bonds, not corporate bonds. Government bonds are much safer in terms for Ray Dalio's. And also another is commodities such as gold, as Ray Dalio has mentioned as well. So how did they actually all work out in the portfolio? So based on one of the interviews or one of the books that Ray Dalio shared, he mentioned that this is roughly how does the portfolio of all-weather fund looks like. But this is just an example. So should you be interested in, more investigation is further required and also based on your risk tolerance for the investing. So we can see that here 30% of the stocks are being invested, followed by fixed income that takes up about 55%, and finally commodities such as gold and other different kinds of commodities are being invested about 15% of the portfolio. So this is generally how much of the different asset classes are being allocated in this portfolio. So people might be curious that why do they wanted to allocate all these assets in this 30%, 55%, 15%? So now let's look at the reason why. So here, we can see that the market expectation, so that means what does the market expect, how it performs. So rising in a way is also means that something like a bull, when it's rising, when there's a high growth, we will see that actually stocks will perform well. And when it's rising in terms of prices such as inflation, they mentioned that commodities or gold will be performing well. So this is one of the reasons why they allocate the asset classes as such. So when there's rising, there's also falling. So falling, people will associate thinking that it's something like a bear market or a recession. So when there's a falling of growth, they mentioned that bonds will perform well in either these two conditions, where there's a falling of prices or a falling of growth, because it's much safer. So an example to give is that, for example, you have money and then you wanted to invest so that it will not lose value due to inflation. So maybe you'll be considered invest in government bonds such as T-bills, SGS bonds, or even Singapore saving bonds. So imagine you invest your money and the government says that, okay, the money that you invested, we will give you an interest payment of about $10 every year for the number of years that you invested in, like for example, 10 years. So for the next 10 years, you'll be assured that you'll be receiving $10 of interest payment. So if the market is performing very well, like the bull market, then you might lose up some opportunities to earn more money. But if there's a recession or bear market where everything is falling, but then you'll be assured that you will still continue to receive the $10 of interest payment. So this is the reason why they allocate a bit more into bonds. So this is overall how the rationale that how they allocate these asset classes into their all-weather fund portfolio. Okay, so right now, this is something that people are more interested in. So since the all-weather fund is being designed to work well in both good times and bad times, how did it perform historically? So here is the chart at first glance. So you can see that the purple line is actually the all-weather portfolio. And the orange line is the 60-40% portfolio, which means that 60% in equities, 40% in fixed incomes or maybe bonds. And the blue line is actually the S&P 500 ETFs. So now let's look at how they performed. So here, we can see that it's 2008 and 2009, where it's the global financial crisis. We can see that S&P 500 actually drops quite a lot, but then the all-weather portfolio is actually a bit stable, even though there's a slight drop. So we can see that actually during the bad times, it may encounter a bit drop, but then it's not drop as bad as S&P 500. Then next, we look at the COVID pandemic, which is around 2020. So we can see that the S&P 500 dropped drastically during the time. And although the all-weather portfolio drops a bit, but then it also rebounds back as per the S&P 500. And you can see that throughout the years from the global financial crisis until the COVID pandemic, the all-weather portfolio is able to generate consistent returns, which is similar to S&P 500. However, when there's a bull market during 2021 and 2022, we see that actually S&P 500 outperformed the all-weather portfolio. This is because earlier on you've seen the portfolio is that they allocate a bit more into the bonds compared to stocks. So even though when it's during the bull market where everything is going up, it may be slightly lagging behind compared to the S&P 500. So this one is more suitable for people who wants to have a stable returns or they hate losers. So it's not suitable for people who wants to have a high growth, because people say that high returns will have high risk. So this is overall how the all-weather portfolio performed historically. Okay, so right now let's look at who is Bridgewater's new CEO. Because earlier on we mentioned that Ray Dalio is now the former CEO. So this is one of the reasons why we come up with this topic, is because we come across this news that Ray Dalio is going to retire. Even though he already mentioned that he has given up his CEO position, right now he's also giving up his CIO, Chief Investing Officer, in 2022 October. And also he's slowly passing on to the new CEO. So now, who's the new CEO? It's actually Mr. Neil Badi. So to be honest, I had no idea who he is until I did research about him. So here's a brief background about him. So interestingly, he's a former Israeli Defense Forces military officer until 2007, which is something very interesting. Only then after he resigned from the military forces, he attended Richmond University for his finance degree in 2012 and followed by an MBA in Wharton Business School. And afterwards, he started his journey in Bridgewater in 2015 as in the research division. And he was being announced as a co-CEO in January 2022 until Ray Dalio stepped down as CEO. So we can see that actually he's quite a fast track in his career since he resigned as a military officer in 2007. Okay, so right now, what is his plan since he already stepped up to take over Ray Dalio's position? So here in this article, he said that the new CEO is actually cutting jobs, doubling down on AI, because he mentioned that it's either evolve or die. So why does he want to do something like this? It's because he aims to boost returns. Because earlier we've seen that Bridgewater is actually being overtaken by Citadel to become one of the largest hedge fund in the world in 2022. And also he aims to increase the profitability and also develop new resources of revenue for Bridgewater instead of just relying on their flagship fund, which is the pure alpha fund. And also they wanted to minimize the dependence on pure alpha fund and all-weather fund. So this is roughly what the new CEO plans is. But then I found out another video which is being nicely done by Bloomberg, and where this expert will also explain like what are the key takeaways by the Bridgewater's revamp. So with that, I'll let my colleague to play the video and enjoy the video.
What stood out to you in terms of the changes?
Well, how much is happening and how quickly? It is only 5 months, as you mentioned, since Ray Dalio handed over control to a younger generation of leaders at Bridgewater, and they are wasting no time. Let's enumerate some of the things that are happening at Bridgewater. They're cutting some jobs, which may strike people as odd since Bridgewater has been generating, positive returns, some 10% since more or less the middle of the pandemic into 10% on an annualized basis. But what they want to do is redeploy some of those resources. They're trying to manage their business efficiently, and they have a bunch of new initiatives that they want to undertake. Very significantly, Bridgewater is capping the size of its flagship hedge fund strategy, Pure Alpha. Why? Because it has come around to believe that by limiting the capacity of the fund, or recognizing that there are capacity constraints to the strategy, it can deliver higher returns for clients. And what's so significant about that, Alex, is that for years, Bridgewater effectively defied gravity. It amassed more than $150 billion in assets, even though it was managing macro strategies. And most other macro strategies aren't anywhere near as large as Pure Alpha became.
Eric, you alluded to other strategies. Let's talk about those.
We should talk about those because they will make Bridgewater a very different firm. Right now, Bridgewater has two principal strategies. I mentioned Pure Alpha. That is a strategy that seeks excess return or alpha, and all weather, which is a risk parity strategy. And they have some other small stuff going. They're doubling down in sustainability. They are expanding in equities. They plan to plow a whole pile of money and talent into artificial intelligence and machine learning, and they also plan to expand their footprint in Asia, beginning with a doubling of the size of their Singapore office. They want to get closer to clients in Asia, and they want to be able to offer better products to clients who are looking for more Asian exposure. Everybody recognizes that in spite of the tensions between China and the United States, an enormous amount of the world's economy is driven by Chinese monetary policy and Chinese credit creation. And if all of those things pan out as they hope they will, each of those four things that I described will, over time, amass billions of dollars in assets themselves, and that will help Bridgewater by making it a more diversified firm, less reliant on those two strategies that I mentioned, Pure Alpha and All Weather.
Hi, welcome back. I hope you have enjoyed the video, which is being nicely done by Bloomberg. So now let's have a quick recap of the key takeaways by Mr. Eric Schatzker. So he mentioned that for the new CEO, they plan to cut jobs and also invest heavily into AI to help them to do the jobs. And then the second thing is that they are currently capping their Pure Alpha fund so that they can able to make better investing decisions in a swift manner. And also another thing, they are now currently focusing onto sustainability, which is something that we heard quite recently about ESG. And also they are also expanding their investment into equities. And they are also actually expanding their foothold in Asia, specifically in Singapore. So these are some of the key takeaways that we managed to get from Bridgewater as of now today. So now with that, let's jump into the next topic, which is the companies that the Bridgewater has invested in Q4 2022. Yeah. So with that, let's look at the first company, which is Costco Wholesale. Yeah. So earlier we have already discussed about Sam Walton, Walmart. We also discussed about another big box department. And tonight we'll be looking into Costco Wholesale. So what is really Costco Wholesale? So it's actually a multinational membership-only big box retail store. So that means you can only buy things as long as you are a member of Costco. And it's actually the third largest global retailer with 848 warehouses in 14 countries. And surprisingly, Singapore also has one recently. And they also have e-commerce websites in 8 countries. So that means their members can purchase things in the warehouse or online for certain countries. And these are some of their core merchandise categories which involve food, non-food, and also other than food, they also have warehouse ancillary like such as gasoline, gas stations, pharmacy, and also tire installation for cars. So now let's look at the revenue that they generated in FY 2022, which is about $227 billion. So we can see that almost 98% of their revenue come from net sales and a mere 2% is only the membership fee. So we can see that Costco actually generate most of their revenue from the sales of their products. Okay, so with that, we know that what Costco is and also what they do, what they sell, but then as value investors, we are more interested to know about their financial numbers. So tonight, as usual, we will be looking into 4 financial metrics, which is revenue. So revenue means the sales that the company is generated. And as usual, we'll be looking about, like, for example, a 10-year trend to see that if the trend is still positive and consistent uptrend, because this means that the company is able to generate sales and bring in money to the company. And also next, we'll also be looking in earnings per share. So for earnings per share, it means that for every one share that the investor purchased, how much earnings or net income can the company generate? Like, for example, if it's a earnings per share of 10, which means that for every one share that the investor owns, the company is able to generate $10 of net income. So this is roughly what earnings per share means. And similar to revenue, we wanted to see the trend, which is a positive, consistent uptrend. So it means that the company is able to generate consistent incomes. And next, we will also look at the cash flow. So cash flow is actually the money or the cash that is generated from their normal business activities. And when it's positive, that means there's money coming in from their business activities. But if it's a negative, it means that cash is actually bleeding from their operations. So as similar as the previous two, we wanted to see the trend is positive and consistent. And finally, we wanted to know that how much debt that the company has. Because if let's say the company is able to earn a lot of money, but the debt, as if like a hole in the pocket, is very huge, no matter how much money you put inside the pocket, the money will slip away from the hole. So we are looking into the company's long-term debt situation, and based on value investing methodology, we wanted to see that this DE ratio to be less than 0.5, which means that for every $100 of the equity that the company has, they cannot borrow more than $50 of debt. So this is roughly what it means for debt to equity ratio. So with all these basics done, so let's jump right into the numbers. Okay, so first thing, Costco revenue has been a positive, consistent uptrend, which is something we like to see. And next, for the EPS is also in a consistent, positive uptrend, which is something we also like to see as well. And you can observe that the EPS is 13.7. So that means that for every one share that the investor owns, the company is able to generate about $13.17 of earnings or net income. So next, we will also look at their operating cash flow. So we can see that even though there's some dips in certain years, but if we are to look at the overall trend, you'll be able to see the trend is in a positive and consistent uptrend. Then followed by their debt situation. So here is the 0.5 line. So even though that some years is above 0.5, but the latest debt to equity ratio, the management is able to bring it down below 0.5, which is 0.43. So overall, we can say that Costco is actually doing well in terms of their financial metrics at first glance. So all these 4 metrics is actually helping us to have a quick look at whether Costco is a company that we should further investigate to check whether is it a good company or is it right now a cheap company for us to invest in. Because all these 4 metrics only tells us that Costco is actually doing well based on these 4 metrics, but it does not tell us whether is it now a cheap company to invest in. So further investigation is required. So next company that we'll be looking at is actually Pfizer. So I believe that after the COVID, most of us has heard of Pfizer now. So what is really Pfizer about? So Pfizer is actually a global biopharmaceutical company where they research and develop biopharmaceutical products such as medicines and drugs to treat diseases, and they also manufacture and sell all these products to their clients such as the patients and also hospitals. So the biopharmaceutical products that they produce are medicines, prescription drugs, and also vaccines like the COVID-19 vaccines. So they have actually two operating segments, which is mainly about biopharma and Pfizer Center 1. So biopharma in Pfizer, it means that they actually research, develop, and also manufacture medicines and drugs for various therapeutic areas or diseases such as oncology, cardiovascular, and also rare diseases. Whereas for Pfizer Center 1, it's actually a global contract development and manufacturing organization, which means that for this segment, they actually help other biopharmaceutical companies to develop and manufacture their own drug products. So in a way that other than doing research and manufacture their own products, they are helping other biopharmaceutical companies manufacture and also develop their drugs. So now let's look at their revenue in 2022. So in 2022, they generated about 100.3 billion of USD, and we can see that majority of their revenue is actually coming from their biopharma segment. Then only 1.3% is actually from the Pfizer Center 1. So this is roughly how Pfizer generates revenue for their business. And now let's look at the numbers to have a quick understanding how Pfizer is doing financially. So for their revenue, at first, even though at first glance it looks like it's in an uptrend, but actually if you look in closely, you can see that since 2013, it's a slightly gentle downtrend until 2021. Because in 2020, where pandemic actually happens, and Pfizer managed to produce the COVID vaccine, you can see that the revenue actually spiked up quite significantly. Then the following year, we see that actually for the EPS, it's actually on a gentle uptrend as well, even though there's some dips in certain years. And for their operating cash flow, which is similar to the revenue, it has a slightly downtrend before it has a sharp spike up in 2021, maybe because of the COVID vaccine as well. And another thing about their debt condition is that we can see that even though almost half of the year are above 0.5 and half of the year are below 0.5, but then the latest number is 0.33, which is below 0.5. So overall, here we are having a quick glance on how Pfizer is actually doing, but in our own in-house case study, we actually deep dive even further more on what happens to all these dips, which later Kaden will share more about this case study. So tonight is just a quick glance to see that how does this company do, whether is it suitable for us to investigate our time and also our effort to know more about the company doing. And finally, the last company that we'll be looking tonight is actually McDonald's. So McDonald's, we know that it's one of the largest restaurant owner operator or fast food chain in the world, where they have location in more than 100 markets, and they have about 40,000 stores worldwide. And here they are actually a franchisee and franchisor model. So based on their 2021 annual report, almost 93% of the restaurants are being franchised out. So instead of operate their own restaurants, they actually franchise out their brands, their recipes to the franchisees to run the operations. So we all know that McDonald's actually sell hamburgers and fast food. So I believe I hope that all of you have taken your dinner and will not be tempted by having hamburger tonight. Okay, so now let's look at their revenue. So here we can see that majority of their revenue is actually coming from franchise restaurants, where the revenue is generated from rent, royalties, which based on the percentage sales of all these franchise restaurants has generated, and also some initial fees when this franchisee wanted to start up the business. But there's something that puzzles me is that why is there a company-operated restaurants? So the reason why McDonald's has a buy model of operation is because even though a part of their business is being franchised out to franchisee, but they still manage some of their restaurants in order to have a direct control over the operation, so that they can actually have a training ground for the new franchisees to learn more about how the business runs. And also, all these restaurants actually serve as a testing ground for their new products, or maybe they have a certain change of their operational procedures where they can test it out instead of test it out in the franchisee restaurants. So here we can see that all this revenue actually is only generated from McDonald's Corporation. So the sales by the franchise restaurants is actually not included. So only the money that is being given to McDonald's Corporation is included into this revenue. So in 2022, they generated about 23.2 billion USD. Okay, so right now let's look at the numbers. So when I was doing the research, the first thing that comes to my sight that the revenue is actually dropping downwards was a bit alarming, because as we know that McDonald's is one of the largest fast food chain, so it should be doing well, right? But then we see that it has been dropping downwards until 2021 before they have a slight jump up and a bit stable for 2021. However, for their EPS, it's actually on a positive and consistent uptrend. Then here for the operating cash flow, even though earlier years from 2013 until 2017 was a slight downtrend, but if you observe slightly closely, you can see that there was a gentle uptrend for their operating cash flow. And for their debt situation, we can see that in 2015, it was a bit high spike up, but then from 2016 onwards, it's remaining zero until 2022. So why is it that the debt to equity ratio is equals to zero? So with that, we will need to go into their annual report and find out what's happening. So from the annual report, they're actually having a high long-term debt. So is this a bad situation? It depends on how the company is actually being run by the management. So in the annual report, it's actually because McDonald's is currently undergoing growth and expansions. So whether will this work out in the long term, further investigation is still required. So there's no conclusion being made at the moment. But should you be interested in McDonald's, I would suggest that maybe you should deep dive further into this company before you decided to invest your hard-earned money into the company. Okay, so to conclude all for tonight's session is that for hedge fund, they are able to generate high returns while minimizing risk for their clients. And they are managed by professional fund managers so that their clients don't have to spend time to find out which assets work well for their portfolio. And finally, their cons is that they are being charged high fees is because all these funds are being managed by the professional managers. And it's only available for accredited investors and institutional investors. So with that, that's the end of my sharing for tonight. And I hope that you have gained a bit more understanding about what is hedge fund and what we can actually get from their investing strategy. So with that, thank you everyone, and I'll pass back the session to Caden. Thank you.
Hi, ladies and gentlemen, welcome back. So let me just put up the last slide in which Hillary has presented, which is the conclusion slide. Now, if you look at the left side, so Hillary talks about, the pros of passing your money to a hedge fund or to generate high return while minimizing risk. Now, this is a very generic statement. So when we say high return, later on we have to quantify what we mean by high, right? Managed by professional fund managers. But before I carry on, I just want to let you know that most professional fund managers, about maybe 90 to 95%, right, cannot beat the return from a low-cost S&P 500 index fund. Yeah, by the way, it is factual, right? You can always Google, which simply means that if you don't want to leave your money with somebody else, you can look at the low-cost S&P 500 index fund, and which also means that if you invest in the S&P 500 index fund, right, using dollar cost averaging, over the long term, good times, bad times, you should be able to beat most 90 to 95% professional fund managers. Yep. So Warren Buffett's company Berkshire Hathaway use a S&P 500 index, right, as a benchmark. Yep. And because if you invest in Warren Buffett's company Berkshire, you're passing your money to him, right? Yep, it's supposed to beat S&P 500 because if it doesn't beat S&P 500, must as well you buy S&P 500. So remember, S&P 500 index fund is a benchmark, which means that outside the scope of this YouTube session where we are talking to you, in case you hear someone say, that there is this fund, there is this, and there is that, oh, 200%, you have to be very careful, right? You have to be very careful because it's very difficult to beat 10%. Yeah, on an annualized basis in a long sustained period of time. Which also means that if somebody tells you that they can do it, you have to take it with a pinch of salt and then really understand where the money comes from. A lot of people say they can make a lot of money, 1,000%, all this. So you have to be very careful. Unfortunately, most of them, right, such scheme end up to be scams. Yeah, so remember, use 10% as benchmark. And then Warren Buffett's annualized return for Berkshire Hathaway is approximately 20% per year, right, since 1965. So in case somebody say they got some investment scheme, again, there is a far superior than Warren Buffett's return. This is even a worse red flag. So you have to be very careful. So that is the pros of passing your money generically to a hedge fund manager. And of course, the cons, right, is they charge high fee. You're passing your money to them, they work as employees to manage the money for you. They need to be paid. So usually fees are quite high. And then at the end of the day, if you look at the bottom, right, only accredited, available for accredited investors. So it all depends on, because different hedge funds, they have different levels of accreditation. Yeah, so for us, I think this to us is a bit outreach. But at least right now you understand the difference between hedge fund, mutual funds, which are available for public, and ETF, exchange traded funds. And one of them is it could be a low cost S&P 500 index fund. Yep. So this is a quick recap of what Hillary has said. And Hillary just now has also nicely shared this graph. Because if we use S&P 500 as a benchmark, let me just go into detail. If you look at this dot over here, right? Yeah, this light blue, right? You can see here light blue. Light blue, huh? So what does it mean? It simply means that if we use this as a benchmark, and if this is a benchmark, of course, if you could find something that's better than S&P 500, that would be great. Yeah, so you can see here, there are two funds that perform better than the S&P 500 during period from 2008 to, let me see, maybe to somewhere around here, this period. So it's quite a long period, right? Let me see, it's about maybe 10 plus years. Yeah, so for 10 plus years, the fund, Ray Dalio's all-weather portfolio, as well as this 60-40 portfolio, you see actively rebalance, actually beat S&P 500. Yep. So in other words, if you put the money here, right, into three different funds, Ray Dalio's fund will have a beaten S&P 500, which is actually quite difficult. And then the interesting phenomenon, which is over here, remember here is about 2021. Yeah, 2021. And then here 2022. Now, if I bought some stocks before in 2021, everybody is a genius. You can buy any stocks that lose money, right? The share price also go up. Yeah, so you may notice that during the bull run, from here to here, right? Somehow the S&P 500 beat Ray Dalio's portfolio, which is all-weather portfolio, and 60-40 portfolio. It's quite understandable, right? It's because for S&P 500, about a quarter, 25% of these 500 companies are usually tech companies. So during bull run, tech companies, it do quite well. Yeah, and then if you look at the all-weather portfolio, if you recall back the circle, right, I noticed that about 50% are bonds. Yeah, actually, I was a bit surprised, quite surprised, right, that he put so much money in bonds. So usually bonds don't, you can't really beat inflation. But I suppose his responsibility is to focus on all weather. And then out of the term all weather, I think since his role is to minimize the risk, the weather he's talking about is stormy weather. So during the stormy weather, bad weather, during the bear market, what are the things that could protect accredited investors as well as institutional investors? So that's bonds. Yeah, which is why I think for the past 1 year, you realize that Singaporeans go and rush to buy bonds, right? Yeah, I mean, during a bull run, everybody go and toss money at crypto, NFT, all this. Yeah, but right now, risk adverse, quickly go and rush to buy bonds. Yeah, and they also put their money into some of the bank's interest rate, which can be as high as 4.8%. Yep. So this is the performance. Now, so the reason why we want to talk about this is at the end of the day, we want you, Hillary, myself, all of us, we wanted to learn, Ray Dalio. Yeah, being one of the richest men in the world, who used to manage the largest hedge fund in the entire planet, right? What is his strategy? And is there something that we can learn from? So I think as I look at Hillary's presentation, what I've learned is if we want to be really risk adverse, then our portfolio, if we want to be really all weather, you may want to consider a segment bonds. Now, how many percent is that? Is quite subjective, but for his, it's quite a huge part of bonds. Now, bear in mind that for people like Warren Buffett, he doesn't really like bonds. Which is why I think we forgot to put one line, right? If you put one Berkshire, most likely Berkshire will beat Ray Dalio's hedge fund performance. So this is what I've learned. Remember, all weather, there's a segment called bonds. And of course, just now Hillary also shared something very interesting. Okay, so if they are the largest hedge fund, it seems to be quite great, right? And then for many years, they have beaten S&P 500. Okay, so is there such thing that we can monkey see, monkey do, right? Is there something that we can copy after them? Now, we have to be very careful to copy after someone. And I think first thing is, who is that someone? Is it someone YouTuber or is it someone Ray Dalio? So you have to be very careful. And then even if you copy after Warren Buffett, if you do not know what he's doing, it's also quite dangerous. It's because I think before the pandemic, he invested in quite a number of airlines. And that includes, I think, the United Airlines, like 3 or 4 airlines. So if you follow Warren Buffett shamelessly, and before pandemic, you buy the airline, and then pandemic came, and then he cut loss and then exit. By the time he cut loss and then exit for you, you'll be like stunned, it's a bit too late. So it's quite important for us not to copy shamelessly. You can see what they do. Like a filtering system. Okay, Ray Dalio, what did they do, right? Or, in Q4, they invested money in Costco, they invested money in Pfizer and McDonald's. So you may notice, if they do this, does that mean that you have to do it? The answer is no. It's no, because if you know when they buy, what they buy, you may not know when they sell. So usually for huge funds, when they sell, maybe it's a bit too late because the share price will have plunged. So number one, so do not follow blindly. Let me just put this, so this is my learning lesson, right? Do not follow, do not follow blindly. So for Warren Buffett, Ray Dalio, if you don't follow blindly, then for any YouTuber, influencer, I think you better be careful because you don't know what they say, right? They have no responsibility in saying this. So they invested in Costco, Pfizer, McDonald's, which is why Hillary give a very quick a filtration, right, by sharing with you some of the financial metrics such as revenue, earnings per share, cash flow, and so on. And the reason why we use some simple metrics is because we also don't want to flood you with 20 metrics, right? We can. So we show you 4. So at least after the session, these are the 4 that we look at. So in case somebody so-called recommend whatever stock to you, right, you can use these 4 criteria as a filtration system. So that you won't gonna, how should I say, being led astray by buying certain stocks. So you're very careful. And I still remember, I think, maybe is it a year ago or less than a year ago, there was one guy, right? His name is called Stephen Lim Koko, right? He once appeared on a podcast, and then he said that he sold his entire HDB, I think maybe 200 plus or 300,000, and then he put all his money into SingPost. And then this guy is quite a cute guy, but remember, he's not Ray Dalio. So he sold HDB, he put his money in SingPost, assuming that you really like this guy. But you must understand that you like him doesn't mean that you have to do what he say, right? You just like him, So he buys SingPost doesn't mean that you have to sell your HDB and then buy SingPost. You don't. Because he do something, you have to think. Okay, check the revenue. Is the revenue, not the criteria that he used, is the revenue going up? Is the cash flow going up? Is the earnings per share going up? How about the debt to equity ratio? So if you use these 4 criteria to so-called make a judgment about SingPost, it's really not a fantastic company. But that is provided you know, which is why the session tonight is important for us to tell you what are the things that you need to know. So remember, you also need to know what are the things that you shouldn't do, which is do not follow blindly. So out of these 3 companies, it just appeared to me, seems like, at least based on the past performance, I think Costco is performing better than Pfizer and McDonald's. McDonald's. So remember, right, we are not recommending anything. So at this note. Then another thing I just want to let you know that if for a fund, right, hedge fund that is as big as a Ray Dalio's fund, just to let you know that in that magnitude, right, they cannot buy small companies, like small cap companies. So what does it mean? It really means that they have no choice but to buy companies that are so huge, like McDonald's, like Costco. So in Singapore context, we call it a blue chip company, but in US it's actually a big cap company. company. So why do I talk about bring these small companies in? Because we are not Ray Dalio. We don't have like billions of dollars. We may have 5K, we may have 10K. So if we want to invest and then grow our money, right? You cannot buy blue chip company if you want to grow our money fast. Yeah, unless your intention is to have a steady income, like seniors, they're very worried. But if you're young, you may want to consider something smaller. And with something of a smaller cap, you cannot do things like Costco, McDonald's, and Pfizer because it's going to grow quite slowly. Now, so let's come back to the Ray Dalio's lesson, which is being extracted from the video that we played right at the beginning. So remember, it's a fool's journey to time the market. So in other words, don't trade the market. Yeah, don't do day trade. Yeah, it's not going to work. So remember, cash is not a good investment because of inflation. And then he shared very important is to create a balanced portfolio, and his is weathered portfolio, which consists of bonds, stocks. And of course, he said we better understand China, GDP, and so on. I think these two, I'm going to address about this, right? Now, at this point, I just want to let you know that Ray Dalio is really somebody. Yeah, he didn't read a book yesterday, and then suddenly he had a hedge fund. Yep. So he will been through a lot to wisdom, right? Make some mistakes in order for him to share some of the lessons so that we don't repeat his mistake. Yeah. Now, so I'm going to talk about this part about China. Yeah, I'm going to sidetrack a bit, and then after that, I'm going to come back to here, right? Now, since we are talking about an all-weathered portfolio, so sometimes during our evening master classes, sometimes during our 4-day value investing program, people may ask, China right now up and coming. 10 years ago is up and coming. So everybody always talk about, there's this product up and coming, there's this company up and coming, or this country up and coming. Or should we invest into China? Now, just to let you know that a question like this, or something is up and coming. Oh, this is really generic. Should we invest into China? Oh, this is also a very generic question. So when I say invest into China, like invest in what, you see? Yeah, so sometimes the question can be so generic, so vague, that it's almost difficult to answer. Yeah, because the question is very vague. And then the assumption is also very vague. Oh, up and coming. They didn't even measure what do you mean by up and coming. Is it the GDP up and coming? Is the GDP per capita up and coming? Yeah. So let's come back to here. Right? Let's say you're really interested in the generic statement called, I want to invest in China because it's up and coming. So let's look at one indicator. There are many indicators, so let's look at one indicator. So for example, in US, if you want to ride the economy rise of US, you may consider a low-cost S&P 500 index fund. So this is recommended by Buffett, right? Yeah. So I can specifically tell you which are the 3 ticker symbols. The tickers are, number 1, VOO, where the fund manager is Vanguard, IVV, and then SPLG. Yeah, so we dividend reinvested is about 10%. It's about 10%. Yeah, so let's look at this. Now, is there something similar to like S&P 500? So since China seems to rise faster than US, right? Now, I've discovered this ETF. ETF stands for Exchange Traded Fund. It's a basket of stocks. Now, it manages by this company called Spider, right? So S&P China, not US, S&P China ETF. And in this basket of stock, it consists of 938 China companies versus the S&P 500, which is 500 companies. Yeah. So if you let's say you buy one stock, if you buy one stock, S&P China ETF. So what are you buying, right? Since it's a basket of stock, that means out of 100%, all the basket of stock, 11% is Tencent. About 7% is Alibaba. 3% is Meituan. So you realize that all these are quite popular China companies. Now remember, the investing is not a popularity contest. What I'm saying is that some of these companies you would know, like JD.com, Meituan, right? Alibaba, Tencent, all these are popular companies. Remember, popular doesn't mean good, it's just popular. So remember, if you buy one stock of S&P China ETF, you're buying a whole bunch of this. Yeah, but before you buy, right, one of the criteria you want to see is to look at the past track record. Because since we're using a S&P 500 as a benchmark, of course, if you want to buy, you better outperform. Yeah, if you underperform, what for, right? Must as well stick to S&P 500, which is recommended by Warren Buffett. So let's look at this. Look at this. Now, Now, if you look at the blue line, this is S&P 500. If you look at the yellow line, this is the China ETF. Yep. So higher is better, right? So if you look at this time frame, let me see, this is 2010. That means this would be in 2005. So if you compare this, you realize that for most of the years, the blue line, right, it overtake the yellow line. And do you notice right now there's a bear market, right? Yeah. So this is a big, this is a bear market. So do you realize that for the S&P China ETF, it drops really a lot, you know, as compared to here, right? Yeah, yeah. So here drop little, rise a lot. Here drop a lot, rise little. Yeah. So for me, yeah, this is not a recommendation, right? Or if I look at this, the S&P China doesn't seem to be very appealing. Yeah. So for me, I won't do it. But at least right now you know what I'm talking about. Now, in case next time somebody recommend you some ETF, how do you do it? You just need to use a Google Finance, right? Yeah, Google Finance, and then you just type in, let's say, VOO, right? Then you can add in other ETFs so that they can plot two lines together. So you use VOO as a benchmark, and then if the line is higher, it's better. If it's below, it's worse. Okay, so that's one way. So right now you know how to fish, Yeah, so don't anyhow buy the ETF, right? So let's talk about the all-weather portfolio. Now, just to let you know that I'm just going to show you a sample. Yeah, sample. This is not like, oh, you know, you have to do this, you have to do a certain percentage. Remember, the Ray Dalio's all-weather portfolio has bonds. So during our 4 days value investing programs, right, we program, without S, we also talk about bonds. Yeah, but the bonds, in our case, we're not talking about company bonds or corporate bonds. We're talking about the government bonds. Yeah, the AAA bonds. Those are offered by MAS, Monetary Authority of Singapore. For example, Singapore Saving Bonds, or it could be Treasury Bills or T-bills, or it could be Singapore Government Securities Bonds. Yep. So in our context, we are talking about this. So since you want to all-weather, right? Yep. So these are the bonds which is capital protected by our Singapore government. Now, but bearing in mind that the purpose of the bonds is not to beat inflation, it's not to make anyone rich. Yeah, which is why it's all-weather. It's all-weather. Then, of course, our context, not US context, you can always invest in CPF. Now, CPF, for you to invest, you can only invest in companies or ETFs that are listed at SGX. You cannot do those Hong Kong, China type, cannot. So this is a restriction. And of course, for me, right, I really like ETF. Yeah, ETF. And of course, just now I said Warren Buffett like to recommend a low-cost S&P 500 index fund. And just now I specifically talk about VOO, IVV, and SPLG. Yeah, so it's just my take, right? If I could dedicate a certain percent, I just put a question mark over here, to S&P 500, and then I do it during good times, bad times, over the long run. Based on the past, it produced 10%. I think it's pretty good, And of course, just now we talked about the different type of funds, right? So right now you know the difference between hedge funds and mutual funds. Now, just my personal thought, you know, just now I said that most funds cannot beat S&P 500. Yeah, so when you select the fund, you have to really be very careful, check the past record. Could it beat 10%? If it doesn't beat, then don't waste time. Then, of course, the other one is we talk about individual companies, like just now Hillary has shared about Costco, Pfizer, and McDonald's. Yeah, but I just need to let you know that it's not so easy for anyone to pick individual companies. Yeah, for many reasons. Like, for example, just now, Hillary is trying to explain to you what is earnings per share, and she had to put a formula there. So in other words, if you don't understand earnings per share, you don't understand profit statement, you can't buy individual stocks. And if you are picking individual stocks right now by watching influencer video, isn't that quite dangerous? Because you are just following without knowing what you are doing, right? And that's also the reason why most people lose money. Yeah, so just to let you know that picking individual stock is not for everyone unless you have the background knowledge or unless somebody teach you, which is why we have been running our value investing program since 2010. This year is our 13th year. So let me just share with you some of the problems that's being faced by investors. Remember, I told you it's not easy to pick individual companies. Now, I don't want to make it sound so easy, right? Because if it's so easy, everybody will become wealthy. Yeah. So what is the first issue, a problem that if you want to do individual stock pick? So number one, do you know where to search for opportunities? Yeah, for example, in Singapore, we're talking about maybe 700 plus companies listed at SGX. In US, we're talking about maybe 3,600 companies. There are so many, and most of the companies are bad. Now, how do you know which one, right? So this is the first challenge. If you have never invested before, it's quite a big challenge. Now, the second challenge is, even if you found it, like for example, Costco or the McDonald's, yeah, do you know how to evaluate? If you don't understand the term, you couldn't evaluate. Yeah, then the third one, even you aga, oh, I think DBS is a good company, yeah. Now, do you know that people can lose money buying DBS stock? Yeah, the reason why is because if they buy at a certain price and they have no idea what the price is, and then the MAS, which about, I think a couple of years ago, they say they want to cap the dividend. And then suddenly the price of all the 3 local banks drop. Yeah, and if you don't understand the business, you may cut loss, right? Yeah, and some people are actually cutting loss on the 3 local banks, which is why the price dropped. So, but it doesn't make sense. So in other words, people can lose money, even for a good business, if you do not know when to buy and when to sell. So most people end up buying high and low. And of course, the last one is, at the end of the day, you want to build a portfolio. You want to sit at a coffee shop, la kopi, right? And then your all-weather portfolio, all-weather, yeah, makes money for you. Yeah. So these are the problems. And because these are the problems, and even for me, Warren Buffett, we cannot do it ourselves. Even for Warren Buffett, he has a Charlie Munger. Yeah, Ray Dalio, he has all his fund managers. One person, he cannot be a genius in everything. Yeah, so for investing, it's a very lonely journey, and each of us, we need to have a team. So you may notice that on the photo on the left, I put Avengers. Yeah, I mean, if it's Spider-Man alone, I don't think he can defeat Thanos, right? Yeah, or even Iron Man. So you realize that even Iron Man still requires Marvel, all these super characters. So in life, it's the same thing. A company is the same thing. And then you cannot be alone, right? You need help from here and there. So investing, we need to have a pool of superheroes, Avengers, to help this, to do all this. And I also cannot do it myself. Warren Buffett cannot do it himself. Ray Dalio cannot do it himself. So what we did was, it's just by chance, right? The pandemic came. Of course, we went through 2 months of lockdown in April and in May 2020. And these are some of our, I call them authors, who are actually our graduates. And then they truly subscribe to value investing, which is a proven strategy that has been around for the past 103 years. Maybe I'll just pick up some name, right? Let me pull out my pen over here. So you can see one of our team members, like the Avengers, right, is Alice. Just to let you know that Alice's background is in accounting. So she knows all the accounting stuff. Yeah, so I need to rope Alice in, yeah, so that she specializes in anything, all the nitty-gritties about the financial statements and so on. Yeah. Then, of course, I also wrote in some people like, for example, private investors. I also wrote in some people who are very good in IT. So you can see system analysts. I also wrote in some people are in the healthcare sector, yeah, or in engineers. So you realize that every single one of these people, right, they specialize in what they do. Yeah, each of them have their own superpower, whether it's engineering, whether it's a finance, and so on. So we even have PhD holders, for example, Dr. Betty Fan. Yeah, so I cannot do the work myself. So we need a team of people. So we need a team of people to do what? We need a team of people to solve the problem that I shared, right? Remember all this problem? Yeah, so how do we solve? Now, so what happened was in April 2020, I decided to pull this group of people, right, who are genius in their own rights. So what we did is we started a project, like a science school project. So we call it project, so that sounds like a science school project. But this project specifically is to identify US companies. Yeah, we will avoid big companies like maybe McDonald's, all this, because these are the companies that everybody know and the growth is quite slow. So for small retail investors like us, it's quite difficult to grow our money if you buy McDonald's. It's really difficult. Yeah, and then I give it a name, right? I call it VIA Atlas. And I call it Atlas is like we're trying to look at companies all around the world. Yeah, but in this case, we specifically focus on those that are listed in US. Yeah, and companies can be from Mexico, can be from China, Hong Kong, but they are listed in US. So that at the end of the day, me and you, right, while you're Lakopi, you have all these great companies at your fingertips. And later I'll share what I mean by fingertips. So a team of us, how do we solve the issue? Number one, the first problem is, remember, I mean, with so many companies, where do we search for opportunities, right? So me together with the team of Avengers, we actually do this work for you. Yeah, because we know how to use different screeners. We screen the companies for you so that you don't have to pay a subscription fee for any screener. So we will do this for you so that you will save not days, not weeks, but months of your time. And time is most precious. Yeah, so that's number one. This is what we do for you. So the second thing, right, we do for you is Even you have found a company like Pfizer, how do you evaluate whether it's good or bad company? So we can do this for you. And just now for Hillary has talked about 4 criteria. By the way, just to let you know, there are tons of criteria. Yeah, I think one company, if we do a presentation, it may take about 40 to 50 minutes. And just now Hillary is trying to summarize in 5 minutes. Yeah, but we don't kill you, right? Overkill you. Yeah, so if you leave this job to us, we can do all this work for you. And it's me together with team, so that you minimize mistakes. Yeah, because you may not know what to do, right? And then the third challenge, since you do not know where's the entry point, exit point, now we can evaluate each individual's company's entry point, exit point for you by understanding this term called the intrinsic value, which is coined by Professor Benjamin Graham. And of course, the last one, right, is at the end of the day, we have to build an all-weather portfolio. And for this challenge, we can help you. Remember just now I showed you the circle? Yeah, so I'm going to pause here for a few seconds. It's either you try to do this yourself or a team of people, in which they are genius in their own field, right, do this for you. That's going to not only save time is just part of the equation. Saving money, that's the most important, because if you do not know, you may lose a lot of money. Yeah, so let me just share with you how this project is being crafted, so that it's relevant, right, for any adults who wish to know more about companies. Okay, so I'm going to explain the process so that you have the detailed info. So today, right, let's say you become a member of our project. Let's say today. And today, let's say it's 1st of January. 1st of January, So what we do is every single month, me and the team, right, the team Avengers, we will look through the entire universe to find a US listed company for you. So in January, you can see this number 2 times, right? That means we'll look for 2 companies for you in January. No action on our part. We do it. We upload into our system. We send a message to you to inform you that it is uploaded. So we do everything for you so that you can access and look at 2 companies. And then in February, we'll repeat. So in other words, every month, we'll deliver 2. So per quarter, you will have 6 companies. 6 company, I think is pretty good, right, for you to form an all-weather portfolio. But that's not the end, right? At the end, the last month or the first quarter, we will have an inner circle meeting. Inner circle, as the name implies, is only for me and the members, right? And you can see the number 1, because this is our first meetup, where we talk about 2 companies in our database, and we will also share, right, 8 to 6 CFOS opportunity. Now, if you are our graduate, you know that we sell options to generate income to replace our salary. So in other words, this is a live meetup. This is a live, via Zoom, right? So every quarter we will meet. So meet at least you know, these are the 6 CFOS opportunity, and you don't really have to do anything. And of course, since we are sharing with you 2 companies, live, right, you can ask the author's question. So in other words, this is a format of what we do every quarter, and we'll repeat this. Second meetup, we'll repeat this. 3rd quarter, 4th quarter. So this is a 1-year program. This is not a 1-day program. This is a 1-year program, with this structure. And in the entire Singapore, we are the only company that does this. So it's a 1-year program. But that's not the end. Now, this 1-year program, we're talking about moving forward. So every month, 2 companies, so that 1 year you got 24 companies, right? But that's not the end. We also want you to have that privilege of accessing our past database, since we have started way back during the pandemic, right? Now, so today, if you have the access to our database, now you will also have access, let me use demarcation, right, of our existing 61 companies that we have done in detail. In detail. And out of the 61 companies, 49, right, which is 80% of the 61, are still undervalued today. Now, if you look at the table at the back, those rows they are highlighted in yellow, right? They are still undervalued today, which means that today, if you have access to the company, immediately you have access to all these 61 companies. You can do whatever you want, right? So, but that's not the end. That's not the end. Let me just show you something even more interesting. You can have instant access today. So remember, you have instant access to 61 value companies. Immediate access. You can see over here, immediate access. And then all these are done for you. Not only that, you have all our summary report. When I say summary, that means in one glance, about 10 seconds, right? You will know what a company do. And then, of course, whenever we upload to companies, we'll send you email reminders as well as a messaging, WhatsApp, right? And not only that, we will have compiled one whole table with all the companies and the respective intrinsic value, and you have access tonight. Yeah, so that is based on our research that we have done for the past 2 years plus. But moving forward, you will be part of our 1-year program. We call it VIA Atlas Project US Case Study. And in entire Singapore, we are the only one that's doing this. Yeah, so can you imagine you have 1-year program, and then you have the 2 years of our database, so total is 2 plus 1, right? 2 plus 1, and you can have immediate access today. Let me show you how the portal look like. This is our portal 1.1, yeah, 1.1, right? So in other words, tonight, once you fill the information, you become our member of this project where we will support you 1 year forward and 2 years backwards. You can key in your username and password over here as the blue arrows refer to. And then once you log in, you can see a lot of things. So let's start with the first benefit that you're going to have. Now, the first benefit it's going to have is if you click on this sector, yeah, you list out the 11 sectors of the entire US stock market. Yeah, so the reason why you want to do this is very simple. Because some of you may be in healthcare, hey, you can start with healthcare. Some of you may be in IT, hey, you may start with IT. So some of you may want to look for very simple business like a Sheng Siong equivalent. So you can look at consumer staples or consumer discretionary. So we classify the 61 existing companies into each of these sectors so that you can find companies based on sector if you want. But if you don't want to select companies based on sector, you want to select, hey, I want to look at undervalued good companies right now. You just hover your mouse over these undervalued companies. You will see one whole long list. Of course, I've hidden most of them. You can scroll, there's 61. And for example, one of the business I still hold on today is called Barrett Business Services, BBSI. It's a HR company. I've been holding it since about 2020. Yeah, when the pandemic came. Right now on paper, even though it's a bear market, I think on average I still make about 50+% since about 2 years ago. Yeah, I think it's a pretty good return. And can you see here? You can see here, right? You can see intrinsic value. Can you see? Yeah, and there is a range, right? Because we use various valuation method. So this is the kind of detail, right, that you're going to get, and you practically do nothing because the Avengers are doing all the work for you, And of course, remember just now we talked about the quarterly meetup. Every 3 months we meet up. Every 3 months we meet up. In case you're busy, something happened to you, don't worry. We'll record all the inner circle meeting right under this CFOS bonus. So you can access, and our members like to scroll to the back to go and see all the 6 to 8 CFOS opportunity. Yeah, remember 4 times per year, just like I shared. So every time when we meet, 2 companies update, new intrinsic value, you can do Q&A with the authors. Yeah, the CFOS opportunities, and these are the the value, right? And of course, if any question, you can ask me. It's a 1-year program, and our next mentoring session is just 2 months away, which is on the 7th of June, 2023. This mentoring session is priceless, And of course, in case some of you are our old graduate, you have forgotten most of the things that we have done. Don't worry, we have professionally recorded some portion of our value investing program so that you don't have to reseat the program again. You can come to this part, click on any of the relevant title, and Cadence, which is recorded, it will explain to you. And in case you are not our graduate, you can also use this bridging course to learn about value investing. Yeah, because we want you to be an intelligent investor. We don't want you to just blindly see, right? It is quite dangerous, Quite dangerous, And of course, just now when we talk about the one-page directory, this is one of the favorite tabs. Is because once they log in, they click here, boom, right, you have one whole list of summary of that 61 companies. 61 companies, and then 80% are still undervalued. Yeah. So if I could summarize the benefits, is number 1, remember, every month 2 times 12 months is 24, moving forward. Yeah, so that will save you weeks of your life. Yeah. And here I purposely put a value, $2,000. And then, of course, for every inner circle meeting, we talk about advanced CFOS strategy that could double your ROI on a monthly basis. Here, I attach a value about $5,000. And of course, remember just now we talked about the quarterly meetup, right? Yeah, together with our authors. Yeah, and we meet up every quarter. And then here we're talking about generating weekly or monthly income. And I've attached a value. And of course, the summaries, the synopsis that we do for you for very busy people. So we add all this up, that there is a certain value. The value is actually more than 16,000 per year, because since we're talking about a 1-year program. So this is a value. So when you invest, this is your like expected return, right? Yeah. Now, but the good news is, if you want to be our member for this 1-year program, plus backtrack 2 years, so it's like a 2 years recorded program and a 1 year forward, so it's a 3 years program. Now, it is only a mere US 1776 per year for this 1-year program. And if you do by a monthly basis, it's about 136. Yeah. So that is talking about 1 year, as compared to some people who are charging like 10,000 to 120,000, right? Yeah. So this is really affordable. But the good news is this. The good news is right now, yes, the economy has opened up. We want really more people to access to the great work that we are doing. So instead of 1776, for tonight, we are giving a 50% discount. So instead of 1776, the entire year, 1-year program is only a mere AAA. And we do it on the monthly, is only $74. But remember, this is the value, right? So this is what you put in, and this is what you get out of it. And of course, after the 1 year, if you find that it's not so useful, it's okay. You can exit the 1-year program. But if you decide to continue with us, you can always renew. And the second year we renew, we actually give a 17% off. So we make it cheaper for you when you are our loyal customer. So for tonight, remember, you can have immediate access to 61 companies, and 49 are still undervalued today, which means that you can build your all-weather portfolio with immediate access to what we have today. So this is the snapshot of what we have done. So what I'm going to do is I will ask my colleague, right, which is Irfan. I just need my colleague Irfan to post the link, right? So in the next couple of seconds, you may see there is a link in the live chat. And the reason why we want to post the link is if the next 1 year, you want to hand over the all this dirty job to us, and you want to join our VIA Atlas Project US Case Study, and you want to become our member tonight. Tonight, you can see the link. Okay, I can already see the link. So what you need to do is you just need to click on the link. Once you click on the link, you'll see this thing pops up. A new page pops out. So your role is just to fill up your name and the relevant information. Of course, email, credit card, and so on. So once you fill up, and then you just click submit. Submit. You can see our deliverables are all here. So once you click submit, in the next maybe 10 seconds, please check your inbox and your spam box to see whether you receive any email. So the email will have the username and password, which means that after you submit, you have instant access to the 61 companies. And the email heading, the sender, right, come from our system called Katra. You can see Katra over here. In case you see Katra, I think there's a spam, right? It's not. So we're using this system, so this is our version 101 of our VIALS Project US Case Study. So that's version 101. Now, or rather 1.1. Now, so just to let you know, if you join our 1-year program, and you also have access to our past 2 years program. Now, the good news is this. The good news is right now our own IT team, we are building another platform. And this platform is more powerful. And for VIA, we dream to become the next Netflix in the world of financial analysis, which is why we will eventually move our platform from Katra to another version of platform, right, which is VIA Atlas 2.0. And we target to complete by end July. So what does it mean to you? It simply means that once we have the platform, you will be the first group of people to have access to this platform. And bear in mind that because we are doing some upgrading, right? The subscription fee of 888 eventually is going to increase to 988. When we have this platform ready by end July. So I tell you first, so that right now you can still take advantage of the discount, because as time passes, because of inflation, right? And then when our system get better and better, things will become a bit higher. But we want you to take advantage of whatever we have today, so that when we transition you from our system 1.1 to the system 2.1, right, there is no additional charge. And then only that second year, right, you have a reduction of the subscription fee. So this is the first good news. Now, the second good news is by and December, if nothing goes wrong, right, we will have our app ready. So this is our VIA Atlas app. So what does it mean? Is, Netflix, when you watch movie, you can use the app to watch a movie, right? But right now, instead of spending time watching a movie, why don't you spend time, spend lesser time, looking at company analysis where we do all the work for you. So that at the end of the day, you have a wonderful company, at a cheap price at your fingertips, which is why we're going to have our app. So these are mock-up. So at least right now, you have a visual of what we're going to do. And the target completion is end December. Now, bear in mind that when the desktop is up, it's going to be 988. And then by the time the app is up, it's going to cross a 9.8. But you can join us by taking advantage of the small amount of fee for a 1 year and a backward 2 years program, which is a 3 years program. So this is just the things that we try to do for our subscribers. So I'm just going to share with you, if you look some pictures. If you see here, right, this picture was taken about 2 weeks ago, when me together with a few subscribers, selected subscribers who have stayed with us for a very long time. We actually travel all the way from a Changi Village jetty, right, to a Keelong, right, to have seafood. They don't pay. We reward them, by doing well in their investment. So this is me. This lady over here, just to let you know that her age is 70 plus. So there's no excuse. I don't think any one of you is more than 70 plus, right? So we have people who are middle age. Middle age. Some people who are young. This is a fun. Fun is taking some photo. You can see the well shaven, right? And after that, after the meal, we also give them some presents, and we purposely selected tea, right? Selected tea is because when they drink tea, they can chill, because of the all-weather portfolio, all built one. Correct, then this is photo taken before we go back. Before we go back. So these are all our subscribers. All subscribers. Remember this lady, 70 plus years old. So right now I'm just going to, remember the link is already there. I'm just talking so that you can click on the link and then you fill out information, right? So while you're filling up the information, maybe I just need my colleague to just play a video. Oh, just to let you know that this is Julie. Julie is really one of our very good customer and right now a very good friend of us. So I just want to hear from her, being a healthcare professional when it's so busy with the work. How can she still chill, right? Drink a cup of tea that we pass it to her. While, investing and make good money, having an all-weather portfolio. So I just need Afan to play the video. Thank you.
My subscription fee, I get it back within 1 to 2 clicks. Okay, I'm Julie. I'm from VIA Graduate Batch 31 and I work in a healthcare company. The reason why I started to subscribe to the US case studies is because of time. I realized that we need a lot of time in terms of doing the research, the filter, the analysis. Sometimes it's very difficult and very tricky. And it's not just as simple as 1, 2, 3. If we have a team who can actually do a good job in doing all these things and monitoring them, why not? It's less than a proper 10-course dinner or a dinner that me and my friend are going later. It's or lunch or high tea or whatever. And you have a peace of mind, you know that these are the value companies, and you know that this can be part of your portfolio. US case studies is not just about presenting the 1 to 24 studies, 2 studies a month, and then they will forget about it. If you realize that they actually go back to reanalyze some of the case studies that they have picked up before, and then review again, is the fundamentals still there? Are they still earning? Do they still have good management? What have they done for the past year? Have they met the criteria or the promise that they say that they're going to meet? Now that I've found out this value investing part can be part of my portfolio, right? Let's say 25%. I have the other 75% that I need to look into. But I know value investing is important. It's the fundamental, it's the base, right? But once I found out this time that I don't need to do or search the world, for the companies, which I know that a very dedicated and very good team will do that, I can actually use my time for other things. Other than venturing into other types of instruments and investing, I also have more time for my family. I do not want to sit there and search for things, rather than sitting down and looking at, what is the company to invest tonight. ROI that I gain from value investing and plus CFOS and the US case studies is about 15 to 20% per year. And it's like 1 to 2% per month. After subscribing to the US case studies, it's very structured. You know these are the companies that has been picked up and searched and researched and analyzed by a dedicated team with all the knowledge that they have to make sure that it's really a value company. So after that, it took me only about like maybe half an hour to 1 hour. So these are all the benefits that I have because I don't have to worry. It's like a peace of mind. I don't have to worry about is the company good or not. I know that the US case studies or the company will be value company. But whether I want to invest in them because it's value company is my due diligence.
Okay, ladies and gentlemen, welcome back. I would like to thank Julie again. Now, you should be able to see my slide, right? So I'll just end the next 2 minutes. 2 minutes, right? Now, a quick recap. Remember, the link is there. Click on it, fill up the information, and then we shall see you in the next gathering. So remember, this is a 1-year program, but we reward you for the further past 2 years of what we have done. Become a member today. So every month, like what Julie was saying, right, we'll deliver 2 companies into your inbox. But she said it's even more than that. Because every quarter, remember, we meet, and then we'll repeat this. Yep. So it's a full 1 year. So in ours right now is April. Now it's full 1 year. If you start April, your program will end next year March. And right now, it's the bear market, it's the best time, because when the bull market comes, it's a bit too late already. And then we're going to prepare you because while we are moving forward, we also give you immediate access tonight, right, to 61 value companies that we have. And out of these 61, 80% are still undervalued, which is 49. And out of the 49 companies, anytime you can build an all-weather portfolio, summary report in 5 seconds, right, you can understand the companies. And every time when we've got any events, any companies that are so-called uploaded, we will also send you email reminders as well as messages. And of course, you have access to that directory with all the companies that we want. And remember, if you join us today for that small little amount, remember AA for 1 year is really super undervalued, right? You have access not only forward 1 year, backward 2 years, and you will also have access to our new platform. By end June, July, we're going to have it done, and you don't have to pay extra. It's absolutely complimentary for you. And then by end of this year, you have access to our app. While the rest, in the future, is going to pay a higher fee, you stick to this. And then remember, by the time a second year, if we decide to continue with our second year program because it's helpful to you, we will reduce a further 17%. So right now it's 50%. Second year, we further reduce a 17%. Of course, tonight's bonus, the most priceless is to gain access to all these companies. By the way, some of my companies are found in this 61 company, but I cannot tell you what. So this is the value. The link is already there. This is my last slide. Let me see. I got no more slide already. So the link is over there, and I'll need my colleague to type in the email address in case you click, you fill out information, cannot find the email login, whatever. Just need to send an email to technical@mykinesis.com. Yes, correct. The email is correct. Okay, good. So, ladies and gentlemen, there's nothing else really. Just click on the link, fill up the information. If some of you are already subscribers, before you exit, do not mind. If you do not mind, right, can you just click on the thumbs up for both me and Hillary? We thought they're very chuan, right? For me, just now I was perspiring, Okay, so for those who are subscribers, I shall see you in the next gathering. For those people who are not, please click on the link, fill up the information, right, and I shall see you. Remember, once you fill up, make sure that you check your inbox and the spam box. If you have any question, just email to technical@mykinesis.com. Don't worry, my team, right, they will report to work 10 a.m. tomorrow. Once they receive this, they will respond to you. Once they report to work, first thing in the morning. Okay, so we are done. So before we end off, just take note, me and Hillary, we represent VIA. VIA stands for Value Investing Academy, and our mission, right, is really we care to make you a better investor. And by providing this project, VIA Atlas, is we want to help you to become a better investor. So maybe we'll just put maybe a 6 minutes timer. So we just put a 6 minutes timer. I'll be here. After 6 minutes, this live will be off. Yeah, and I shall see you in our next deep dive series. So again, thanks a lot for Hillary and Irfan for supporting us. So 6 minutes starts now. Now click on it, fill up the relevant information. If you have any question, please feel free to post in the chat, right? I'll be here until the next, until 6 minutes up. Yeah. So any other question that you want to ask? Yeah. So let me just click on the link. I'll be here for the next 6 minutes. Yeah, we have also pinned up the link. Just click on it, fill up the information, and we can talk again. Yeah, let me just go back to the structure, right? Yeah, so that you can see. Yeah, this is our 1-year program. Now I'll leave this screen here so that if you want, you can take a photo and so on. Wendy, thanks, sir. Thanks a lot for our precious time. Thanks for always following our deep dive. There's a lot of work, but I think the key thing is we have learned the difference between hedge funds, mutual funds, exchange traded funds, and ETFs, right? We know who is this guy, Ray Dalio. He's really a big shot. Big shot. So in other words, if some big shot did something and say something, and his fund is the largest fund, there must be some logic, success factor. So we want to learn from him. And of course, I think the so-called secret, in which just now Hillary has actually reviewed, right, is he has this all-weather portfolio. And it's not like one size fits all. I suspect he got many different variations of portfolio. Of course, the one is, there's one with a huge amount of bonds, about 50% bonds. So that's all-weather. But if you want to grow your money fast, I think that putting 50% in bonds is a bit too much. Yeah, because bonds don't beat inflation. Yeah, so you may want to string that bonds and then put the rest into something else. But if you want to put in something else, you must know. If you don't know, it's quite difficult to really put. Yeah, which is why we are doing all this work for you. Yeah, maybe about 3 minutes plus. Any other question you want to ask? I think there's still about 50 plus watching this before we really knock off for the day. Yeah. Any other things that you want to ask? Okay, let me just go back to the challenge, right? Yeah. You see, if you look at these photos, all these are, how should I say, they are like working adults like me and you. They have their own issues they want to solve. And of course, their priority is to focus on their family, their health, their work. Yeah, because analysis can be quite time-consuming and difficult. Yeah, if they don't rely on someone, I think it's of course, not only just rely on anyone, but rely on some people that they trust. That they trust. And just now we talked about the app. We talked about a new platform that we're going to launch in end July. And of course, the app is end December. Yeah. And this is currently our platform 101. Yeah, we'll be shifting to platform 201, right? Yeah, over here. And these are the challenges that most investors will face, and our job is to solve all this problem for you so that you can drink tea, kopi, right? And then we take care of all the rest for you. Yeah, remember, click on the link, pops out, fill out the information. The discount will be for today. Yep, so that when the new platform is up, you don't really have to pay any extra. Let us do all the work for you. If our grads, this is a 1-year program, and I mean, AAA is really affordable. Yeah, as compared to some, like 160,000, right? Yeah. Okay, any other question? I think it's about just 1 minute plus more before we knock off. Yeah, before you leave, do not mind, please help us do a thumbs up. Yeah, so that maybe YouTube rank us higher, that sort of thing. Yeah, any other question that you want to ask? I'm looking at the chat. I'm turning my right to look at my phone, right, so that I can see. I think almost time's up already, huh? I think less than a minute, right? Yeah, 1.5 minutes. Any other questions before we end this YouTube live? When we end, the link will disappear, right? Yeah, so please click on the link, fill up the relevant information. Any question, email to technical. Okay, I think should be less than a minute right now. We still have the 50 plus watching days. Interesting, right? Yeah, who are you? Yeah. So these are the profiles of our authors. You know, sometimes every day I'm so busy, you know, I won't like put this on my laptop and then try to look at the faces. Yeah, so right now as I look at them, I think as I look back, I think this entire 13 years of journey is worth it. We have traveled to 11 cities in the entire Asia. We have trained more than 50,000 people, and I think more than maybe 99% of the people that we have met are really good people. Yeah, so these are just a small subset of the huge group of people that we have met, and I think I'm personally glad that they are on our side to serve all of you. I think time should be up quite soon. Ready? Okay, last a couple of seconds. Any other question? Last 10 seconds, right? Before you knock off, click on the link, pops up, fill out the information, take your time to fill up, submit, right? And I shall see you in our June 2nd Inner Circle meeting. Okay, good. So we have come to the end. So remember, we are VIA Value Investing Academy, and I shall see you soon. Okay, goodbye. Thank you.